Hello everyone. Hi, welcome to the channel of Wall Street Mojo. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you everyone. Cheers. Friends, today we're going to learn an accounting concept which is known as the double entry accounting system. This is one of the most crucial and one of the most important concept because it is being followed at the global level. Double entry accounting system has a great level of significance while recording your journal entries based on which your ledgers are prepared and your trial balance, and then you go for the financial statement. So let's understand the basic concept of double entry accounting system, which is like the backbone of the entire accounting system. The double entry accounting system refers that any entry made in the system will have at least two accounts. Very important word. One of the account needs to be part of the assets and other has to be part of the liability, and hence the effect is exactly equal and opposite. The two accounts effect has to be equal, but it has to be opposite. Assets and liabilities are opposite to each other. So if asset will increase, then liability has to reduce, but there will be equal proportion, right? Let's understand this in a complete detailed fashion. See, let's understand what is double entry accounting system. We need to learn this. This is the first concept. Now, the double entry accounting system is prevalent, in majority of all the countries across the globe that follow. So a systematic pattern of maintaining transaction entries into the system. I can simply write that it is globally followed, which should be which should give you a great level of importance for this particular concept. The double entry accounting system, basically it refers that any entry made to the system will have at least two effects. One will go to either assets and other has to go to the liabilities. So let's say if the asset is increasing by 100, then the liability has to reduce by 100. So the amount is equal, but the effect is opposite. Over here it's increasing, over here it's decreasing, right? So it's equal but opposite. This is what is the backbone of a double entry system. Now let's say consider if a person purchases something, say a handbag, and there'll be one transaction where he pays the amount for the bag. Now, as per the double entry accounting system, another corresponding transaction should be created. So it should be a receipt of the handbag so that there is a net effect. So once again, if a company offers a service, let's say car cleaning services, and one transaction should be the amount if it receives, right? And you can say that for the service rendered, which is actually transaction made in terms of the money. However, as per the double entry accounting system, one or more transaction needs to be recorded. So the reason why the amount was received by the company and hence it is recorded as the service revenue account, right? Let's understand the double entry accounting example. See, these examples are going to teach you a lot. Let's say there's a guy called John. John basically purchased a laptop for, let's say, $5,000. Writing 5,000 over here. And he paid cash for the same from all the savings he had made for this. And hence the entries for this date should be because the laptop, which is the asset that is increasing. So your asset is increasing and your other another asset which is decreasing, which is your cash. So your laptop account is debited and your cash account is credited, right? Now, what is exactly happening? See, either the assets has to reduce and the liability has to reduce with the similar effect, or the asset increases and the asset decreases, or the liability increases and the liability decreases. This is the first scenario where you can see laptop is also an asset, cash is also an asset, but over here the laptop is increasing, that is the asset is increasing, and your cash which is going out, so your cash is decreasing. So in a way, both are the assets and they both are getting affected. Let's take another example to understand this. Let's say again John basically booked an office table for his new setup. So over here, office setup for $2,000. and he paid $1,000 in, let's say, advance, and was due upon the delivery after the table was ready. And the entry should be posted in the double entry accounting system on the particular date will be something like this. What is coming in? It's the furniture, because that's the asset we are purchasing. And for that, we have paid an amount, right? So furniture account has to be debited, and the debit amount is the total value of furniture, which is $2,000, right? Let's pick up the number from here itself, $2,000. The next is cash. Cash account is credited because the cash is going out. How much? Because the advance is 1,000, so 2,000 minus 1,000 that has been paid, right? Okay, this is in dollars, so I'll just write 2,000 here. So 1,000 is going out, right? And there will be creditors outstanding because you need to pay them in future, or you can say the accounts payable, because you are going to pay them in the future. You haven't paid, it's outstanding. So this will be credited to 1,000. So what is happening? The furniture is coming in, the asset is increasing. I'll write for you over here as this is your asset, right? This is also your asset. Okay. So what you can see that, the creditors is over here is your liability, right? This is your liability, and your cash is again an asset. So what you can see, the furniture, the asset that is increasing by 2,000. So either the asset has to reduce or the liability has to increase, right? So at one end, 1,000, your 1,000 asset is reduced. But what about the balance 1,000? So something has to increase or decrease. Either the asset has to decrease or the liability has to increase. So because you haven't paid, you have paid only 1,000, so the outstanding is 1,000, so your liability is increasing. So you can see the net double effect that has been given over here. Now the first case is a clear example of the debit. This is corresponding to the credit, and the net amount is 0, as you can see. In the second case, although the three accounts were given effect, the net entry between the debit and the credit is 0. Hence, the double entry accounting suggests that every debit should have a corresponding credit. Now, whether the transaction is realized or not, in order to totally get nullified on the date when John booked his office table, he had paid only how much? 1,000. And even the rest of the amount is not actually being paid on that day, so it becomes accrued in the accounts payable account, which means it is supposed to be paid on the later date. And once, let's say, the amount is paid, the accounting entry is going to be reversed. So your creditors, which were in credit, because now you're paying, so it is getting reduced. So your 1,000 will come over here because you're paying them by cash. So your 1,000 will be credited because your asset is reducing and your liability is again reducing, right? So liability is getting reduced and your asset is also getting reduced over here, right? Now, let's say, let's quickly understand the advantages of the double entry accounting system. See, double entry accounting system is accounting that brings standardization across all the industries and companies which use it. The double entry system is helpful in the overall reporting structure. That's important. I mean, double entry system, the company analysis gets simpler since, there the parameters and the entries can be decoded by anyone. And you can say the auditing task is also made very simpler. And you can say that, there are some disadvantages to the same also, which we need to discuss. The disadvantage are something as follow. The individual accounting terms and entries may create the huge list of the chart of the accounts, and tallying and comparing with those used by the others for the further analysis would be cumbersome and really time consuming, plus the waste of effort. Second, it creates some level of confusion and the possibility of the multiple entries, thus creating, incorrect balances. The third point is that, the equality between the assets and the liabilities, or like, debit or credit service like check for the matching all the types of transactions. Had the check not existed, then the trouble in the system of the accounting can be estimated. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.